Welcome to the NITRUS Talk. Our alumnus Satish Dave from 1988 batch has agreed to give a talk on investment strategies. And just brief introduction, Satish graduated from our college in 1988. And he also did a law degree from Nagpur College, Juris doctor. And he also has a strategic management degree from Harvard. That's great. He has been working in this field for a long. He is with Riata Capital Group. He's a managing director, and then right now he is a CIO of a division of that company, AEG Vision. So in this talk, Satish will speak, and then he can keep it interactive, and or if it can be a full talk for the whole period, and then at the end we'll have questions. So Satish, please take it away.
Okay. Morning, guys. And I'm going to share the screen and let me know if you guys can see. I have not used Google Meet much, so hopefully this works. Okay. Are you guys able to see my PowerPoint slide?
Yeah, we can see, sir.
Okay.
Yeah.
So what I will do is maybe let's take, I don't know, 30 minutes or so. Let me walk through this. And then right now I cannot see any of you guys or if you guys raising hands. So if you guys need something, just
Yeah, I have an eye on that. I keep an eye on that. I will interrupt you if somebody wants.
Yeah. And this topic came up a few times, and as I was sharing in the beginning, I wish I knew some of these things in the beginning. When I came to US in '88, and people used to talk that right before the Y2K boom, people would say, "Oh, I bought this one, I made this much money," and so on. And I had several close friends who were really successful, right? And most of the time, trading meant trading by the news or knowing from the friends saying, "Hey, this company is kind of upcoming," and so on, and buy the shares and so on. So, I strongly believe when you have desire and intense desire, things come to you in different ways at the right time. And I think there are many ways to get there. And this is what I'm going to share is a little bit of my thoughts and my journey, pick pieces as you like. And, start with the intention, what you like. And my thinking is not just trading anything. If it is not simple, if it is complex, I mean, there is something I walk away, right? And the slide kind of everybody knows this. Most of the time, the retail investors are looking when stocks are going up and I'm going to make money. Actually, we can make money both direction, and that's what the professional traders do. And they short, and we'll talk a little bit how you do that. So, and then the good thing is when the stocks are going up, it's like taking stairs, as you see on the graph. Most of the time it's that way. And when it comes down like a falling knife. And we saw in last 3-4 days, right? This could be the NASDAQ or S&P or most of the stocks graph for last couple of weeks and so on. I believe there are few things which kind of I will focus on: the mindset, education, and education means unlearning the way we do things, right? And then different instrument and how do you leverage the money you have, because we all have limited money, at least most of us, and then how do you leverage it to the most? And then obviously tracking helps. So this slide may not look like totally at anything to do with the trading, but in my opinion, this is the most important thing, the mindset. And the mindset is, many times we feel oh my God, this is so complex. I'm not educated to do those kind of things. I don't have time. And we are generally operating out of constraint or operating with the mindset of challenges. And in my opinion, once we kind of tune into the creator mindset that, hey, I own this, I know how to do it. And once we start shifting, then we become the magnet and things start coming to you in terms of knowledge and success and everything. So I just listed the 2 optional books. These are great reads. not just, they are nothing to do with the trading, but to create a creator mindset and keeping the thing simple. And I think somebody was talking when we started talking, the two things which kills in the trading world is the FOMO, fear of missing out. And then when the stocks or whatever instrument you're trading, when they're going up, it's difficult to walk away because we always want that extra squeeze, right? So I think this is very important, most important thing in my opinion, because technical part, everything we can learn, but this is something we need to kind of like own ourselves, own our life. And once you kind of like feel comfortable in whatever you're doing it, it's not like creating an ego, it's more about feeling comfortable in where you are and what you do. So with that, let's move into, like the more trading things, my journey and so on. So one of the thing, like the difference between the retail investors and the institutional investors. So institutional investors are like people like Warren Buffett, or like the Goldman Sachs or JPM and all, right? And so as an example, if you or me want to go and buy 100 ballpoint pens, we'll go to Walmart, whoever, and the price, whatever it is, we might say Walmart is selling for $1.40 per unit, and then we'll end up buying it, right? There is not much negotiation going on. You might go and say, hey, maybe Office Depot is selling for 135, and so on. But and this is kind of like an example of how people come with big money. When Walmart wants to buy 10 million pens, they go China and say, I want 10 million and I'm going to pay 40 cents each. And they put out their grounds, and they basically have different manufacturers come back to them, and that's what they buy. And they buy it for 40 cents, whatever they're shipping, and they sell it to 140 cents. 140 cents, yeah. So the thinking here is basically that institutions drive the market demand and supply and price, right? And the same thing applies in the investor world. So if you think about roughly, the market size varies, I think has grown quite a little bit. There are two types of investors, right? Retail investors and institutional investors. 90% of the money comes from institutional investors. Many time, like over 401k money and all those kind of money, that is being dealt by institutional investors, right? So let's take the example. This is an old example or old slide where IBM was 155. It's higher than that. And generally in a day, IBM trades about 3.5 million shares. So, like you can buy or sell that many shares in a day. So if John wants to spend $100,000 to buy IBM stock, I'm sorry, if John has $100,000 in his account and say, I'm going to spend $10,000 to buy IBM stock, he can buy 64 shares, right? And he will put the order will get filled immediately, boom, done. But when you think about Warren Buffett, who has like now 200 billion plus cash, and he says, I want to put $10 billion in IBM, right? At that point, he will need $64 million shares. So what is happening is, like, even if he if his company tries to buy all at once, 3.5, they cannot buy more than 3.5 million share in that day. So what happens is, at the end of the day, there is an unfilled order remain, right? So they're thinking to buy 64 million, maybe they bought 3-4 million, right? And the unfilled demand is sitting there. And what happens is, like, when more buyers are coming, demand is coming, the market starts going up. The price will go up like 155, 160, 175. But the institutional investors are coming in saying, I'm going to buy at 155. When it goes anything more than 156, 57, they stop buying, right? But this typically happens. Price go up when more demand and so on. So the point of this slide is, when big investors are coming in, there will always be unfilled order remain, right? And this goes both way. So this will kind of like one good indicator saying, hey, when institutional investors are buying or selling, can we identify those market demand locations, right? And what big investors do is they significantly manipulate the market. And like I'm not going to play the link, but this link is there on the YouTube. And if you Google it and search it, you will find too many people talking about this thing, saying how people come in, the institutional investor come in and they manipulate the market. In this particular link, Jim Cramer is talking, saying, hey, whenever I need to create demand or whenever I want to short, how they will go with a small set of money with the news media and everything, that they create the buzz saying, hey, NVIDIA is going up or NVIDIA is going down. And then by the time we following it, they are planning to go other way around, right? So even if they can uptick NVIDIA by $10 and they're selling 1 million shares, that's how they kind of like, in a way, somebody can say it's one of the biggest um, uh, fraud people do from a institutional investor's perspective. But we as a retail investor will mostly buy on the news, right? And then the other thing to think about is the trading style, like which we all know, whether you want to do trading, day trading, meaning you are in and out in few minutes or like in less than an hour. The swing trading is kind of like where you buy something, you will hold it for like a day or weeks. And long term, which is kind of like a intra month or intra year. Before I was doing this active trading, I will start with saying, oh, Apple is going up, buy it. And then when Apple goes down, I will become long-term investor, and it will keep riding for 5 years, 10 years, right? And that's how you still make money, but you are not taking advantage of going up and down, right? And then the other way to think about from a trading perspective, like your regular income versus wealth management. In my opinion, like if this is something excites you, you may think about taking a small money and create a supplemental income. Say, I'm going to learn this thing, and you may say, I'm going to make like $500 or $1,000 a week extra just to play from whatever like play money you take out. And once you kind of like get comfortable, then you can increase your stake and potentially can replace or significantly improve your earning. So that's one way of thinking. The other way of thinking is like once you get really good at it, then you can say, oh, I can do a better wealth management from my retirement planning perspective and so on, versus putting money in the mutual funds and ETF, where like those small fees of 0.5%, 1% every year can end up as significant money over a period of time. So the next thing I want to talk was different kind of, my slide can move, instrument, right? So now we know, okay, what's the difference in the institutional investors and the retail investors? And then everybody has finite money. So I'm taking this example, say if a trader has $20,000 to trade, right? Most people generally buy and sell shares. So if you're buying a share worth $100 each, you can buy about 200 shares. And if the share goes up by 1%, $1, you make $200. That's 1% on your return, right? If you are doing day trading, some people can leverage that 2 to 1, and then maybe we'll make $400 in that day, and then or in that period, and that's like 2% return for your $20,000 investment. I think the fun part is like the more you can leverage your money, that's where you can make more money. So options are like very complex, right? You can, if you own shares, you can use them as insurance, and you can go pretty crazy. But here what I'm giving is an example of very simple. I'm buying option. This is what I do. I learn all the trading about option, but the only thing I do is I buy option as in lieu of shares for more leverage. So in this example, the same stock, say I'm buying a contract which is going to expire in 6 months, and the delta is 0.8. So 6 months gives me an option. Say, for example, Tesla is a perfect example. If I'm buying today, most likely will the price come up by $10, $20, $30 in 6 months is very high, right? The delta, what it means is like if the price goes up by $10, if my delta is 0.8, I will get $8 gain, right? And if you know in the options, the purpose here is not to teach what is options, futures, etc. in detail, but just give you an option, very high level um, uh, idea. Each contract for option, and they expire depending on every month or every quarter or every week, represent 100 shares, right? So with $20,000, with the per contract is 20, I could buy 10 contract. And now with this $20,000, I am basically managing behind the scene 100,000 worth of shares. So it's like 5-to-1 leverage. In the same way, if that it goes by $1, right? And then your gain would be, because you are having like 10 contracts, it's about 1,000 shares. And for each dollar you're getting 80 cents, your profit would be $800. So that's 4%, right? And the fee and are like very nominal, probably less than $10 or something. So option offer are obviously, like the higher leverage, but at the same time, there is a risk because each contract has an expiration date. But like if you're buying for 6 months, it's like some people, sometimes I buy option for like 1 year from now, then my contract price, premium price is higher, but less than share price. I think the futures are my favorite, right? So futures are kind of like like people are betting, saying, hey, if Nasdaq is going to up by this much percentage, and your Dow Jones may have this thing, your crude oil prices may go up. So these are like the derivative trading, and people use it from a in the financial market perspective, from a speculation and hedging. And so this is pretty big game from a institutional investors perspective. Futures, forex, and options, most of the time, that's how these people make a ton of money, right? So let's take an example of a Nasdaq contract. Each contract will have like a different, the Nasdaq contract also have expiration. So if my Nasdaq moves by just 1 point, I can make $20 profit, right? To buy a Nasdaq contract, I need at least $18,000 in my broker account, and that may vary a little bit by $500 to $1,000. So for your $18,000, one contract of Nasdaq, roughly kind of like you have the leverage of $300,000 for one contract of Nasdaq, right? And if it goes up by 100 points, you make $2,000. That's like 11% profit. And just so you know, on an average, Nasdaq moves 1.1%, right? So it moves more than 100 points quite often, right? It does not mean that you're going to get the uh, gain of like 100 points every day, or like short of 100 points every day. But this is just an example that all of a sudden now you're with the same 20,000 amount, you can make you're leveraging instruments worth $300,000 and making significantly higher profit. There are tax benefit too. Like when you buy and sell stock same day or hold less than a year, they all are considered as short-term gain, and then you pay whatever your income bracket is, 30-40%. In the future world, the 60% is your short-term gain, and 40% is long-term capital gain. So there is some benefit there. But I don't trade futures for that. I trade futures for leverage. And the forex, which I have intention to do sometime soon, but I have not done it. This is the same thing. The currency pair. You may say, hey, euro is basically, like, for now, it says 1.2 of a US dollar. What's going to come in up and down? And so they're like multiple pairs. So you Japanese yen, euro yen, dollar yen, Australian dollar, Canadian dollar, all that. There are like 20 plus major currency pairs. And this is one of the biggest market, like about $7 trillion get traded, very liquid and very highly leveraged. It's much higher leverage than forex. And I learned futures trading about 5 years back, and I do sometimes the forex futures, and this is something I would get probably when I have more time, I guess. So this is, I think, This is how you can, with the same amount of money, how you can leverage it more to gain more profit. You're taking similar level of risk, but now behind the scenes somehow you are able to leverage a bigger instrument and bigger market assets. So similarly, like now we know about different instrument and so on. The thinking, as I was talking in the beginning, you can think about from a income perspective and a wealth perspective. As we go more ETFs, like bonds, etc., that's kind of the safest way, which most of us do anyway. And then when you start looking from an income perspective, you can think about, okay, I'm going to look for a daily, weekly, or monthly. So as an example, if I'm looking for like, and these are the like times probably you will put in the beginning, like once you kind of like get comfortable that how much time do you need. If I'm doing a daily trading, I will spend 1 to 2 hours a day, like because I need to see how this market is going up and down. Even if you preset the orders when you want to buy and sell, that's you do most of the time, but you still want to be active and see what's going on in the market. Whereas the swing trading, where you are looking at, I want to just start say $1,000 or $500 a week to begin with. That's the amount of money you will spend. And the last piece here is, depending on what kind of trading or income you're looking for, that's kind of chart you're going to look at. So, and we'll talk more about this in a slide in a minute here. But daily, like if I want to do daily trading, you're just looking at like sometime 1 minute chart to max 15-minute chart. You will go into the hourly chart and see what the trend is, and within the trend, you're looking at 5 to 10 minutes. For weekly income, probably you're playing somewhere between 1 hour to 4 hour, and then daily chart and so on. So a little bit more about futures. Futures, I think there are like many types of future contracts. So when you talk about equity contracts, as you can see, S&P, NASDAQ, Dow, Russells, and like different outside. I limit myself to the US equity indexes. You can do the interest rate, currencies, and then commodities are interesting, like the energy, metals, agriculture, and so on. So they expire. So the most of the financial equity related indexes expire every quarter, but when it comes to commodities, some of them are monthly, some other every other month, and so on. The good thing about the futures when you start trading is you are trading 24 hours a day, and so is Forex. And the only time you're not trading is the market closes 5 p.m. to 3 p.m. So most of us, like who's working and busy, the thing is you can basically do before you go to office or when you come back to the office, right? And then you need to spend a little bit more time when you're learning. And then once you get comfortable, then, like for me, generally before when I get up in the morning, I will spend 15 to 30 minutes. And during the day, I'm just keeping like very occasionally I will go and do something. And sometime in the evening before going to bed, I will make sure changing my orders and so on. So we were talking about that IBM share examples, right? So when Warren Buffett, the institutional investor, is trying to buy, they cannot buy in one day. So what we can do as a retail investor is we can be the fly on the horse, right? I should say fly on the horse. I'm saying fly off the horse. Typo. But I learned this thing, and I'm going to share that detail from like a trading academy. I used to always think, hey, where can I go and learn this kind of thing? And people go and learn all kind of like a deep dive technical analysis. I had one of my best friend, Harish Watwani, he passed away. He was very deep into technical analysis. He did a lot of trainings and so on. It was very impressive, but very complex. Honestly, like that was above my pay grade. I could not understood properly. So I kind of like gave up on that. So I learned this thing from tradingacademy.com, and I'm going to share you more details here. What they basically tell you is, like you always first want to understand the trend, right? So if I'm doing a, say, looking to do trading in like an hourly or 2 hour chart, generally I'm going up and looking the trend. How is the trend looking for my daily and weekly charts? And the first rule is that you generally don't want to go against the trend, like at least for the retail investors like us, because we don't have that volume. And then two, like as an example, if you are playing like a day trading or swing trading, which is intraday or intraweek, probably the best place to trade is in the uptrend and downtrend. But if you are doing day trading, you can trade during the sideway trend as well. And what sideway trend is telling you is like, hey, if this is a daily chart, like the market goes up and down pretty much within the same bandwidth, and that happens for a period of time, and then ultimately it will go up or down, right? The other thing which they teach you is how do you identify the demand zone, right? So they will basically, they have a patented way which they will teach you to understand, like when the institutional investors are trying to put money either to go long or short, and there are unfilled orders, right? And that's where they will teach you to say, like, hey, this is the unfilled demand zone or unfilled supply zone, and then you can basically, once you learn it seems complex, but once you practice this for like 3 to 6 months, it's a very easy process, right? And that's where you can place your orders and so on. One thing, like the think about is, well, I have a separate slide for, and that's, so I'm going to hold on the thought, but that's how it is, like how we, most of the time as in retail investors, we are looking into the news saying, hey, why is Tesla going down? And it's interesting, last 3-4 days are perfect example. Somebody saying, like if you look here, NPR news are people talking on CNBC and Bloomberg, and they say why market is up or down, right? Whatever happened during that day, they're saying, hey, because of this sentiment, says market is up or market is down. 90% of the time there are geopolitical events which can really fear factor and all can really move the market, but most of the time the institutional investors either buying or selling, like they everybody has to show their quarterly results. People sell out, institutional sell out, and that's how they show in their books saying, hey, I made this much money. Like many banks, most of their money they're making out of that this trading and so on. So how do we kind of like, for me, the news is like less than 10%. And what these people will train you to just understand and identify where are the unfilled demand and supply zone, right? And sometime when market goes down, like it happened like in the last 3-4 days, don't try to catch the falling knife. Like sometimes there is a fear of missing out. Hey, if market starts going up, what happens? So these techniques will help you saying, hey, if market is going down, and then you will be able to go back and now and see in the hourly graph that market is either stabilizing and going up. Then you can say, okay, if it's hourly market, I'm seeing that market is stabilizing and there are other indicators like RSI, then I can now start putting my demand order or supply order for based on a 4-hour or a intraday chart. And we'll see a little bit in the next slide. So here is an example, right? So think about that. If somebody, this price shot up significantly, right? And this could happen for various reasons. It could be either this is a weekly chart, right? That somebody was trying to buy big number of shares, and all of a sudden because of the demand, prices went up. And then you will see that most likely, depending on what the time frame you're looking back, if you go and play, you will see the chart will come down, because the institutional investor who is trying to buy, they put something and they say, I'm not going to buy more than this, right? And the same thing they can do to selling too, from a short perspective, that at a certain point I'm going to sell it. Similarly, here is another example, right? When the price was kind of like a little bit stable, and somebody tried to buy it, went shot up significantly, and then came down, right? I think this slide might be like few days old. Probably, I'm guessing IBM is down again for this level. So here the thing is that, like, if you're looking at an example 4 hour or daily intraday chart, you will see these things up and down, right? And then you can identify these demands and put your orders, and then you just basically on a daily basis or maybe like a couple of times a day just going back and say, do I need to adjust this order, right? If this would have been the day, if I had put my order here, I would have moved this order somewhere here, because knowing that, oh, there is a new demand zone, right? And what you are seeing in the bottom is the RSI indicator. So any time when it's the, like, RSI indicator is more than 60-70%, means it's kind of like peaking out. As you can see here, it's peaking out. When it came down, it's coming down. And then anything below 40% RSI is pretty good. So if you go in today, and we'll see here at the end, at least pick one chart, and I will show the RSI, how the market is going down and the RSI is going down as well. So that those are like good supporting indicators. So for me, what I did, and like, there is no way that I'm just saying this is the only way to do it, but I think that the tradingacademy.com, what they do is basically they do a half-day introductory session all over the country, right? I would suggest, whether you're interested or not, attend that, right? And by end of that 3-4 hours, what they will teach you is basically some of the things like what I was talking about: different instruments, retail versus institutional investors. They do better job than me. And then they will try to sell you for like 2-day market timing class, and it's $299. I would say do that. You will become very well educated about different instruments and different trading styles and so on. And by end of that second day, that's where they will try to sell you their big classes. So the way they work is the core strategy is they're called like patented way. How do you identify, like the unfilled supply and demand, and be the fly on the horse? So they claim that is their patented way of doing it. And then along with that, you may want to start with one instrument. My suggestion would be start with futures, because options you can pick up with that small delta very easily. And once you feel comfortable, then you can go for more. So I did started with the core strategy as well as futures, and then I did options. So one of the big thing here is to unlearn, like how we trade, that depending on the news and so on, versus saying, hey, I'm going to just looking for unfilled demand and supply, and maybe a couple of indicators like RSI. And then that becomes the mantra. And you always, like geopolitical thing, if there is a war starting or something, you will know there is disruption in crude oil supply, all that kind of stuff. And these trainings are not cheap, guys. Like they probably, if you're buying core and futures and then the mastermind community, which I'm going to tell you, they probably are spending $30,000-$40,000. That's about going to a college for a 1 year or one semester. And I spent 40-ish thousand. And then in first year, I lost in the first 3-4 months. I kind of like lost because I had not done proper paper trading. But by the end of the year, I had recouped everything. So I think there is high potential to do this, learn and do this. So the other thing is, like when we are talking as a novice trader, the retail traders, most of the people, like we are always saying, hey, I win all the time, and when then they lose big, right? And then this graph showed you pretty much whatever gain you had, you pretty much wipe it out, right? Whereas when you go through the proper training, understanding, like the typical supply and demand, what you do is basically, like even if you're focusing on, if I'm taking $100 risk for that trade, I should have at least $300 to $400 gain, right? So if I'm looking for 3x gain risk to reward ratio, then even if I lose 6 trade out of 10 and make 4 trade, I will still be positive, because you're not risking more than 2%, right? And then when if you the probability, obviously, like the odd and answers and so on, there are like other detailed trick where you can reduce your probability of losing and so on. One thing for me worked out, I would say, like after a year or so, that like generally they will say you should not take more than 2% loss and so on. Once I got comfortable, I started taking more loss. So sometime if I have to hold it longer, like right now I'm holding longer, I know the market will come up and I will regain that. And that has played out significantly well for me. But in the beginning, all the tools they teach, how do you do your risk calculation and all, helped me significantly. Right. And this is no way to kind of like say, hey, online trading, now they have renamed to tradingacademy.com, is the only way to do it. But based on my research, they came out pretty good to me, right? And this is another slide, a little bit about the futures contract. As you can see, like if your S&P goes by 4,000 to 4,001, you are by $1, right? So most of these, like NASDAQ, S&P, if my contract goes up by 1%, right? The price goes by 1%. I'm making like $1,500, $2,000 in that period or in a day or a few days, and then you can be out, right? You don't have to worry about, and that's where we talk about FOMO and greed, right? So once okay, I'm comfortable, I'm making $1,000 a week. Once you make it, just get out, right? And have a mindset of closing your P&L on a weekly basis. And then you will know that, okay, I'm not making 1,000, I'm making 500, and then slowly you go up to 1,000, and then the sky is the limit. So the training, as I was talking about, the core strategy training is 1 week training, and then followed by you will take another instrument training, right? What thinking is generally, once you're done with those things, most of the time you come out of the training, you feel very good, and then after a few days, doubts starts coming, right? And then, oh, how do I do this? How do I identify demand and so on? The good thing with these people is you will have access for 90 days. They call like XLT, where their pro traders are doing the trades live at least 3-4 times a week. You can join and you can see what you are thinking versus what they are thinking is the same or not, right? And they have this called like mastermind community, for which you pay, I forgot how much, I think 5,000-10,000 extra. Then your family member can basically take the training as well for free of cost. By the way, you can take the retraining as many times as you want, it's free. And in the mastermind community, and I will show at the end, they pretty much publish what they think the the unfilled demand and supply are for different time frame on a daily basis. So they do the mastermind session, I think 4 session a week or something. Earlier I used to join every day, and now basically I join once in a week just to make sure that what I am thinking is the same or not. So in the beginning, I would say probably good 3 to 6 months, you're spending about 2 hours a day doing all this thing. And then once you kind of like play like with the paper money, feel comfortable, start with the micro contract, right? So in the previous slide, when I was showing that in this mini contract is $50 gain, and then you need probably $18,000 to play. For this one, you probably need like $3,000 or $4,000, and each point will make $4, right? So play with the smaller money, and then at that point probably you're spending a day or so. And I'm talking about like if you're looking for weekly or monthly, I generally now look at the monthly P&L for myself, and once comfortable, then you can move to the full mini contracts and options. Most of the time I do options as a substitute for shares. And the other thing is, always, and I learned this way hard way, keep 50% cash no matter how good or bad opportunity is, because days like what you're seeing it, if you have 50% cash, no matter how much red you are, once you see that market start ticking up, you can use at least 25% of that cash to average out your cost, and that's where you will make most money, right? And I talked about the portal community. So let me see if I can pull Thinkorswim just for a second. So this is like a NASDAQ contract, right? So as you can see, when market slammed, right here, you can see the RSI is, so let me zoom out a little bit. See these like unfilled orders. As an example, you can see there was demand here, somebody bought it, and then it came down here, and you will understand the candle chart, what these thin line means versus the candle body. And you can see this thing keep coming back closer to this. It came down here, and then it came down here, and then you will learn that the demand is not permanent, right? At certain point, the demand will fail, and that is where you saw the market went down, right? And if you go in and look from a daily or weekly charts perspective, you will see a different view. If somebody is trading it for a longer period of time, that's where you will see, hey, this is more like in a weekly demand zone right now, right? Here, from here and here perspective. And then if you look from a day charts perspective, you will see slightly different perspective. So if generally I'm trading with the 4-hour chart, and I will come back and closely look at the daily chart as well. But if I want to see, okay, is market behavior is changing or not, like you will come back at the lower chart and say, okay, if the trend has started shifting on an hourly, and there are ways, like where your lower lows, your lowers, the close of the whatever time period you're looking for, 4-hour or daily, are higher, and your higher high, when your highs are higher than the previous day, then that's where you know that a market is breaking the trend, right? So these are like some ways you can look into and play with different time frame to understand what trend you are in. As we saw earlier, it was a downtrend from a day perspective, right? And then I believe market will come up because there are like no big geopolitical things. So this is more driven by buy and sell situation. At least that's what I think. And yeah, the last couple of slides, account size does help. So as an example, if I have 50,000 versus 100,000 versus 20,000, like you're going to put saying, hey, I want to buy when NASDAQ goes as this level, or Tesla goes at this level. So every time you put the order, like your broker will say, okay, now from 50,000, one contract of NASDAQ, you 16,000 reserved for that. So the more money you have, the more fish nets you can cast, right? It does not mean that all orders will get, trigger, right? Maybe most of the time, 20% orders will get triggered. There are days or week where no order will get triggered, and that's okay. But account size does help you with the probability of catching the fish. And we talked about falling knife, and then look for the upwards or downwards trend, and play both sides. That's where the fun is. The last piece, which I would suggest, is start with the small goal, right? So with the training wheels, paper money, then the training wheels, $100 to $500 income per week, then 1,000 plus, and increase however you want. And with this kind of trading and learning, pretty much I ignore the technical analysis and fundamentals for most part, but there are a couple of things you need to be aware of. Fibonacci, as we know, being engineers, is how the universe operates. It's so complex, but everywhere you see, from a lotus flower to unique, the Fibonacci ratio is similarly applicable in the trading world as well. and RSI indicator. Those are like a couple of things which I generally keep eye on it.
Mhm.
So that's kind of like high level presentation. Took longer than that, but any thoughts, questions? I'm happy to answer.
Yeah. Thank you, Satish. This was very informative. And just let me just give a um, announcement which I should have done before. So for everyone now and also anybody watching this in the future, this is not a professional advice. This is a very complex topic, and just you cannot become an expert in 40 minutes. Satish has shown the way, and I think for you to explore your own research, and he has given one information about one academy which worked for him. So do your own due diligence. And by the way, NITRUS Talks or Satish, we have not been paid by the Trading Academy, just to put it on the record. I think it worked for him, so he shared, and it may work for you also. So
I had the disclaimer line in the first slide, very small.
Yeah.
But guys, like we are all friends.
Mhm.
Do unlearn how you've been doing, and if like if you don't like trading, don't get into it. Like if this is your passion, money making passion, go for it. Like doesn't matter where are you in your career. I would, like if you go to these training, they will say, hey, you can start with 5,000 and all. I would say no. At least like 50,000 in my opinion is a good amount to start, but you can still do with 25,000. But 50 to 100,000, if you can take risk and play with it, you can. I think it's very much doable.
Great. So let's go with question answer. What we do is we usually take questions from the chat first, and then people on the bottom of your screen, you will see your hand. So you can raise that hand, and that makes a queue, and we can go to that.
Yeah.
So from the questions we have, let's see, we have comment from Vinod Ravindran that he has heard of YOLO also. Hey, Ravi Kumar has a question. You want to go ahead? You can unmute yourself and ask the question, Ravi.
No, sir, it was not a question, just the efficient market hypothesis where the price is perfectly priced in, whereas it's not efficient from the price that is baked.
Okay.
Any security. Yeah.
Thanks. Avinash Pandey has a question. How do you hedge your position to minimize loss?
Yeah, I think, and like as Rahul was saying, the purpose of this was just to give you a glimpse about how to go about training and the possibility. And you ultimately will have to choose your own path. But some of these training which I discussed, that's where they say you never take more than 2% risk, right? And then you keep your reward to risk ratio to 3x, right? So that's where you basically, even if you lose 6 trades, as I'm giving the example, and win 4, you will still be positive, right? So that's how you control the risk.
Okay, thank you. So Balraj Singh has 2 questions. We can take one for now, and then later, if we have time, we can take the second. So Balraj, you want to read? It's a lot of things I would like you to read.
Yeah, sure, also. So this my question is that you mentioned about the demand and supply zones related to the unfilled gaps. So I wanted to understand a little bit more about specifically on the unfilled orders. How do unfilled orders affect the demand and supply? Is it only the unfilled orders that affect the demand supply zones, or are these the other trapped traders at those zones that also to those zones, the demand and supply zones? A little bit more about that. I have not used it yet, but definitely would want to see if I can get some edge onto that.
Yeah, so like go back to like COVID period, right? You had a limited supply of toilet paper, right? And then more demand. They will come in Costco and will be gone, right? It's the same way as in the stock market too. As I was saying, like there is a volume for different equity and so on, and then once people start buying more, you will have unfilled order. And the same way when people are cashing out or shorting on some stocks, that's how you have like short in supply, right? So and through this training and so on, you learn how to identify those.
Okay, thanks. So the last question on the chat is by Suraj Kota. By the way, Vinod Ravindran, I think you raised hand because that came after the last, after we started question answer. So Suraj asks, do you recommend professional training for passive trading? Passive trading.
Yeah, I think my question and next question, like from Vinodji, is also like aligning a little bit. Like is there, it, like is trading and investing like this, like the same thing, like where you hold on to the stock for a longer time? And do you recommend like professional training for like longer term trades?
Yeah, so it depends, like what your goal is. Like one of the slide we talked about income versus wealth management, right? So if the passive trading to me is more about the wealth management, do you rely on those mutual funds and ETF and go with the market up and down? Or do you kind of like, hey, Apple is a long term, I'm going to hold on to it, then it's going to go up $10, come down $2, and then so that's an individual choice. If you want to actively manage your wealth, yeah, you may want to get some of these trainings, right?
Okay. So I think we are done with the questions in the chat. So we'll start allowing people in the hands queue. So Rochesh, you raised the first hand first. Please go ahead.
Yes, sir.
Rahul sir, sorry to interrupt. Maybe we should give a chance
Hey,
for Vinodji to see if like their
Suraj,
question was same.
Suraj, may I say something? Yeah, let us go through the raised hand. Also, they're waiting. So we can definitely give him a chance in the end. Rochesh, go ahead.
Yeah, so I think my question was bit basic, but I do understand. Like, so we are not talking very technical here. Like, what is our entry point, or what should be our exit point for any of the trading? That I think that sort of discussion we are not having here. But tell me, sir, one thing. I'm thinking about the options in a leaf fashion. So, in a leaf option, if when we do you think that that is a better chance to get the win profit?
Yeah, like I'm a I say this in a positive way. I'm a dumb guy, right? I go for simple things,
Mm-hmm.
right? And there are people who do all, like there are like 28 types of options trading you can do, literally, right? And I took training for all of those, and I determined that no, that's not my thing. I'm going to simply buy and sell as a, like a, instead of buying shares for full price, I do the call or sometime put, and then futures trading, right? So that's the path I choose. But I know a lot of people make money by doing different kind of trading and options, but I'm not the expert there.
Okay, just one more question, sir. Yeah. So I see in YouTube also there are different groups are there who charge monthly and they do advise. Like instead of we going through all these charts and everything, I think they do all these works and then they can help us out. Do you think that's kind of help us? Like we don't want to put our brain there to analyze all the charts and everything, or you think what you think? Like we should be learning this by our own. What is your more recommended way?
I think it's individual preference, but if you decide to do it yourself with some of the way I was talking about, you can literally replace your primary income with this, right? That does not mean this is, I'm saying this off the record as a friend, you won't quit your job or business, but you can start with a supplemental income, and that may become your main income source.
Yeah.
Okay, thank you.
Don't risk everything. As I said, to each his own. Everybody's risk potential or risk tolerance is different.
Yeah.
So let's go to Subhash, sir. So, sir, please ask a question.
Up mute, sir.
Sir, you are mute. You may have to unmute.
Yeah, okay, fair enough.
Yeah.
So, Satish, it's a great talk. I must appreciate this. It's a wonderful talk that you gave, and you exposed us to this great field of investment, which I tried long time back in India, and I burnt my fingers. So I gave up. I went to the SBI mutual fund, put some money, didn't find much of return coming to me. When I came to US, I didn't have much fund, but finally I got some funds and I put it to. I followed the Warren Buffett and other advice. that put into the SAP, these index funds. But somehow this is of deep interest to me. I'd like to learn a little more about you. One clarification I need, because I must ask you a question. When you refer to the contract, is these contracts have a duration, or are they linked with the up price and the down price? What is the contract basically?
Contracts have a duration, right? So as an example, the equity index contracts like expire in January, March, June, December, right? So as I was talking about option, most of the traders are trading now the March contract for futures, right? And which are going to expire in like 15 days. I am trading June contracts. I will start trading September contracts. So that way, like at least you have more time play to see if market goes up and down.
So within the contract period, you can come in and go out anytime?
Yeah. So like day traders will be in and out, like somebody will buy 10 contract and they'll say, if I'm up by 10 points, 10 multiplied by $2,200 per contract and 10, $2,000, they're out in like 30 minutes.
So what benefits do you get into the contract? I mean, you could even otherwise trade anytime and come in anytime, go anytime. So what benefits do you get into a formal way of contract?
No, so the contract is just a term, how you units you buy the futures contract.
Oh, I see.
Yeah.
Oh, I see. Okay. Thank you.
Thank you, sir, for questions. Next is Kamal, and I think we'll stop the raising hand at this. After Ashish Agarwal, I'll give chance to Vinod, who had asked a question. And Rochesh, you sent a question on the chat. Maybe you can follow up offline. We are already running about an hour into this. So, but if you are done quickly, we can take you.
Okay.
Kamal.
Sure,
please ask
sure.
a question.
Thank you, sir. So, sir, just one question related to the trading. So, when it comes to trading, right, you prefer to do trading in index or individual stocks?
I do futures and options.
Okay, not individual stocks, like nothing like swing trading and that kind of thing, right?
Yeah, I think, I don't know when you join, that's where like how much do you leverage you want, right? With the shares, you just control, you spend $1, you control $1. With other instrument, that's where you get the leverage.
Okay.
Yeah, that's amazing. I had no idea about that. Thanks, Satish.
Thank you, sir.
Then next is somebody called Neural Spark. Can you go ahead? Also introduce who you are.
Hey guys, this is Gopesh. Actually, I joined double joined. Actually, I didn't realize that I use my company ID. So yeah, thank you for the question. One, I had just simple question. The risk reward also depends on the sector, or we can is a fixed or depends on the sector.
Sorry, I could not hear you properly.
So risk and reward ratio that you told about, that we need to have the ratio of 2% loss and you can maximize your profit. So you're given certain ratio. This ratio depends on the sector or not? Or this is a fixed across?
It does not. It's for anything, right? So generally the way you want to put an order, say, hey, I'm going to buy something if it comes down to $100, right? And then if it goes down more than like $98, it will be automatically sell, right? And then instead, if I buy at 100, if it goes to like $106, then it will sell automatically. I'm not going to worry more about that. So that's like your risk to reward 3-to-1.
Okay, 3-to-1. Okay, great. Thank you.
Thanks. So the next one was Gopesh's second account, so I lowered that hand. Going to Ashish Agarwal, please ask your question, and after that we'll go to Vinod, and if we have time, we can take Rochesh's question also.
Yeah, so my question is, based on your experience with options trading, do you prefer to buy options, sell options? I mean, I've been doing that for a few years as well. And if so, what deltas do you use for both buying and selling options?
Yeah, I generally do like 0.8.
So buying, okay.
0.8, and then I use the contracts which are like 6+ months minimum. Most of the time I buy for 9 to 10 months, 9 to 12 months. So that's like how much money premium you want to pay, and then that's you control risk.
And mostly buying options or both?
Yeah, call options buying. Yeah.
Okay. Thanks.
What about the puts, sir?
You can You know, like when you're selling put and all, you get some money, all that. That's what I'm saying. Like contract has like 28 types of trading you can do, and you can get as complex as you want.
Okay, let's take Vinod Ravindran's question. Vinod, you can unmute and ask the question.
Yeah, first of all, thanks Satish and Rahul for this session. Great session, Satish, and great insights into options, investor trading, and about unfilled orders. Right? I don't do futures. I only do long-term stocks and options. And I think somebody asked that question earlier about risk to reward ratio and calls and puts. I do mostly calls and puts options, mostly cash equivalent puts, especially because we all came from a place where we are told from the very beginning, if you don't have money to spend, don't spend it, right? That's what cash equivalent puts means. Means if you don't have the money, no matter how much put option you put, at the end of the day, if your put get assigned, you need to have that money to cover that, right? That option, and options are contracts. So my question was mostly around for beginning investors, right? What do you recommend actually, whether they should go for long-term stocks, which is buy and hold, or they should go for small options or futures trading?
I think the one is the interest, right? If you think that you want to do actively trading, right? If you want to buy stock shares, they go up, big companies and so on. Like I don't have a viewpoint on that. But this conversation was, if you want to do active trading, learn it properly, trade with the paper money for 3 to 6 months. So you're not endangering your money, and then go with the smaller, those micro contracts we were talking, take a smaller risk, small gain. And then once you feel comfortable, say 6 to 12 months, somewhere in between, then go and play with real money.
Yeah, well said. Yeah.
Okay, so thanks, Vinod. Rochesh had asked a question. Rochesh, you want to ask the question?
Yeah, sure. Yes, Satish sir, I'm not sure, but yeah, if possible, sir, last week or the last Friday, NVIDIA chart we can go. If you can show us like how it became like after hours the price went up, next day and again it came down, and just before the closing the market again it went up. It's hard to understand like how this works.
Yeah, and I think I think we saw one of the NASDAQ chart. It's the same way, like it goes up and down, right? And then the long-term investor will say, oh, I know NVIDIA is going to go up, right? And then you can continue to kind of like buy or sell,
Yes,
hold it. But at the same time, like these things, I don't pay attention to these things, right? So you just ask, like, you see, this is a good example. Like from day perspective, it came down to like your day level here. These are two levels, and then it went up, right? So probably it's going to go up here and then maybe come down, dance a little bit, and then this is a big drop. At some point, it's bound to go there, and of course it will beat.
That must be the deep sake thing, I guess.
Yeah. So all that kind of thing, like when these things happen, like that's the point of proper training. Unlearn how we do trading, and then go with the proper training.
okay, sure. Thanks.
Yeah. And there is two ways. You can go technical analysis, fundamentals, which is very complex, and I'm sure it works. That's what goes up there.
One is small question, sir, before we wrap up. So, after hours, who does all this trading, which makes the stock so volatile, like it upside or down, like how it works?
So extended hours, like if you are qualified traders, institutional, you can do like 1 or 2 hours before the market or after the market, right? And that's the fun of the futures trading and forex trading is you can trade in the evening, right? You see, so there is a US market where that's where the most action happens, and there is the European time when the European market happens. That's big, 6 hours or something, and you can play in any time.
Okay.
Yeah, I think it's like Costco, right? Some people can go in before everybody else, I think.
Yes.
So Ashish had already asked a question, raised hand. I don't know whether it's another question, but Ajay, that will
My
be
bad. I'll take it off. Sorry.
So Ajay has raised a question, hand. So Ajay,
Yeah,
that's the last question. Please go ahead.
Yeah, sir, it was very really nice talk. I have quick question. You mentioned that you only do for the US market, but does it same principle apply for India market as well, or that like what do you suggest for India market?
Techniques are the same, but I'm like not familiar with India market at all.
So
Techniques, supply demand techniques are the same. I think
Yeah.
I heard India recently started futures trading there too.
Yeah. Can I comment about the India options market? Guys, here in US, we trade what are called as American options. So you can go in and go out anytime. So these American options, they're not European options. In European options, you have to hold it till the expiration dates. And usually the trading is not as, the lot sizes are not 100. They vary. So in India, the options market is very different. So make sure that you learn the Indian markets before you start putting your money in. The best way to invest in India for most of the folks is going through various mutual funds, or there are India ETFs. And if you want to leverage it even further, you can do trading on those ETF options as well. But US is much more sophisticated. India is very sophisticated, but there are a lot of instruments that are not traded over there.
Okay, thanks, Inderjeet. So I think what we can do is we have come to the end of this call. I will just say a word of thanks, and then we'll stop recording. And if anybody wants to hang out, we can have more discussion if we want, and that we can continue for longer duration, as long as Satish has time. But let me stop the recording. But before that, I want to, say thanks to Satish for this insightful presentation. I learned a lot. I mean, I'm like one of the worst investors ever, and after this, I think I will probably improve. So thank you so much. And with that, I'm going to stop the recording. And thanks everyone for joining. This will be presented, put on our NITRUS Talks website, maybe after a week or so. We edit the talk and then we put it on YouTube. So I'm stopping the recording now.
Thank you so much, Satish sir. It was